Welcome to the HMO Property Show. By investors, for investors. Catch us weekly as we discuss all things cash flow positive property investing. Whether you're a seasoned investor, a new landlord, or just curious about property investing, this is the podcast for you. Sponsored by the Co-Living Collective, your trusted partner in creating vibrant and sustainable shared living experiences. Visit us at colivingcollective.com.au to learn more.
Welcome back to the HMO Property Show. I'm your host, Neil Gibb, and this week I want to take you through some statistics and some information and data around the Perth market, because there's a few people that say the Perth market's hit its peak, and I've got some stats to show you today which I put together for a group of entrepreneurs that I had the pleasure of presenting to at a little restaurant in Perth. To tell them about the opportunities in the market. And someone reached out to me and just said, one of your clients is in this group of entrepreneurs. He said, you're doing some good things. I'd love you to come down and present to the room of people just to talk about the Perth market in general. So I quickly put some slides together. I had a few days to prepare and went down there and just took them through the same information I'm going to take you guys through today. It's going to talk about the state of the market now, why we're in the state of this market, and more importantly, what to expect over the next few years. Now, for the people that are as confused as everybody that I tend to speak to about our companies, I just want to quickly run through what the Co-Living Collective is and the other brands that we have underneath it. So the reason that we put the Co-Living Collective in place was as a master brand for the other brands that we had underneath. So everybody will know me, or should know me, from the HMO Property Co, or what used to be J&G Property Group, which was our property management business that my wife and I set up in the early days to manage our own portfolio of properties, because we couldn't find any property managers to manage them as we wanted managing. We recently rebranded that from J&G Property Group to Living Rooms, because J&G Property Group sounded very corporate, and that's not what we are. So Living Rooms is our property management business. We've still got the HMO Property Co. That's our development, property management, and kind of marketing arm. Reside is our SDA and standard property management business. We're still waiting for our SDA and NDIS registration so that we can be a special disability accommodation provider. And then we've got Co-Built, which is our building company, which we've just relaunched. We did a few builds in it a couple of years ago. We weren't quite happy with the way things were going in it, so we made some changes. We brought in a different builder to run the company for us, and we are relaunching that now, and we're ready to start building and showing everybody what we're actually capable of doing in that building company. So depending on who we were talking to, I could come to them from one of 4 different companies. So what we did is we put the Co-Living Collective in place as our collective as companies, all focused on co-living HMOs. HMO Property Co, obviously, everybody knows it as the HMO Property Co, doing HMOs. Living Rooms, yes, we know that's our HMO property management business. And then we've got Reside, which the reason that I wanted to get into it is 2 things. First thing, providing accommodation for people with disabilities is close to my heart. My father suffered from and passed away from Huntington's disease when I was 27, and my sister unfortunately has got the defective gene, and she's been in full-time care for the last 12 years. She's on end-of-life treatment and has been for the last 18 months, and I've seen the accommodation that they live in, which is essentially aged care facilities in the UK, because there's just no quality bespoke accommodation for them in the UK. And when the opportunity came up to provide that kind of accommodation to the market in Australia, I was interested, but I was only interested because the way we were building these houses was to get multiple people in a house at once. So not 6 people with disabilities, but we would put 2 people with a disability and a carer in there. So them bedrooms, or them houses, have got 3 bedrooms. So it's technically co-living for people with disabilities. So that's why we put that, that's why we brought it into the group of companies that we've got, and that's why we helped our investors invest in that style of housing. And then we've got Co-Built, like I said, that's only going to build HMOs moving forward. And that's why it's there. We just want to give the best journey, the best outcome, the best delivery, the best experience for the people that do want to work with us. And I am extremely passionate about getting shit done for our clients. It frustrates me when things don't go smoothly. It frustrates me when they don't have a good experience, and I, hand on heart, do not want that at all. And I have regular meetings with my senior leadership team to iron out the creases that occur for any growing business. No business is perfect, but we're trying our best to be the best we can possibly be. There's going to be issues, there's going to be things going wrong, there's going to be new problems to solve, and I think I've got the right team around me to help solve them problems as they pop up. So, now cleared that up. For the people that don't know who I am, or the journey that my wife and I have been on, I'll give you a little bit on there. There's my beautiful wife there. She's pregnant as I record this. She's 2 days overdue. She's on the verge of popping. And then we've got little Freddie G up there as well. He is just the best. Loving to bits, and we can't wait to get this little girl out as well so it can complete our family. But we started to invest in real estate in 2014. I worked in the oil and gas industry. I worked for some of the biggest companies in the country, Chevron, ExxonMobil, Impex, Samsung, Clough. And then I went across to Woodside. And the reason that I went across to Woodside, I was sick of doing fly in, fly out. And I wanted to get a job in the CBD. And by that time, I think it was 2017, 2018 when I started working for Woodside. By that time, we'd already started our property investment journey. So I could step away from fly in, fly out, spend all my time at home, but combined with the income from Woodside and the income from our property portfolio and the property deals we were doing, we were actually coming out with more money than what I would do if I was doing fly in, fly out. We worked hard, don't get me wrong, absolutely worked hard to do that. But you've got to work hard enough to not have to work hard again, right? And we still work hard now, believe it or not. But there was a point when I replaced my income. I was financially free. And at the time, it was exciting and also nerve-wracking because I was thinking to myself, what am I going to do with my life? It turns out I've then started helping everybody else build property portfolios as well. So, look, we started in 2014 where we were doing renovations, flips, that sort of stuff, making 30 grand here, 50 grand there, 60 grand there sort of thing. Then we started doing some small developments, and then we started doing HMOs in 2015. Our principal place of residence was the first property that we converted into a HMO. To cover our asses, we didn't know this was going to work, but to cover our asses, we moved in with the mother-in-law. Now, I always say, live a few years like most people won't, so you can live the rest of your life like most people can't. Are you keen enough? Do you want it enough to move in with the in-laws for a certain period of time? It might be fine for some people. It was fine for me. I got on with Paula really well and Jim really well, and I appreciate them taking us in. We only stayed there for 6 weeks because we filled all of them rooms in our first property within 4 weeks, and we got almost 2.5 times the rent as the property next door, which was sat in the market vacant. And at the time, there was 17,000 properties available on the market to rent. And we rented all of these rooms out in Hammond Park, 25k south of the CBD, within 4 weeks. That's when we knew that gave us the confidence to then go out and lease another property, and we started rent vesting so that we could have borrowing capacity and serviceability to move forward. 2017, we established J&T Property Group, which is now Living Rooms. We did that to manage our portfolio of properties because it was getting too hard for us to work full time. I had a good job, good income. Jo had a really good job, good income. She was a project director for a marketing company working for some of the biggest brands in the country. And once we set up J&G Property Group, people started asking us to help them with their properties. Can you convert this for us? That's why I set up the HMO Property Co. It was like a project management company to project manage the renovations that we were doing for other people, which we did, lots of them, probably over 100 to this date. Once we had the HMO Property Co. set up and J&G Property Group set up, people started asking us again to help them. So we were still working full-time jobs here. I was managing renovations from the Woodside office. Sorry, Mr. Woodside, if you're listening. But yeah, I was literally building my business from their office. I was getting all my work done for them, don't worry. But I was smashing everything out by 1, 2 o'clock. And then I was spending a few hours in their office just planning things from my own business. And then I was getting out, leaving the office, going out, seeing how the team had got off on renovations during the day, ordering furniture packs, stuff like that, and then pass it on to our property manager. In 2019, and I'm probably talking about this for a little bit too long here, guys, but this, if you haven't heard the journey, this is the journey. In 2019, it says here, I left the oil and gas industry after I had 6 HMOs generating over $110,000 a year. I was technically financially free. What happened is, and this was in January 2019, in December 2018, I went to a mastermind with my mentor at the time, Ian Ugarte, and I sat in the room, and Ian went around the room and he said, what problems are people coming up against? And I put my hand up and I said, I feel like I'm just going too slow. I feel like I should be doing more. I was I'm still very driven now, but then there was just this mad drive to get to a certain financial target. And I said to Ian, I just want to go faster. I want to do more. And Ian was like, look at it. It's kind of spelled out all the things I was doing. You've done all these HMOs. You've got all this income coming in. And I said, the only thing that I need to do is leave my job. But because I'm earning such good money working for them, I can't walk away from it. The best thing that could happen to me would be to get the sack. Now, I went to work. I was in Queensland Friday, Saturday, Sunday. We flew back Sunday night. I went to work Monday. On Tuesday, I got the tap on the shoulder to say, Neil, the company that you work for, subcontracting to Woodside, has lost the contract. And in January 13th is going to be your last day. Now, they did this right before Christmas. This is the oil and gas industry. They do not care about you at all. You're just a number. Sit down in your seat, do the job that we tell you to do. We'll pay you good money to do it because you've got experience, but we really don't care about you. We really don't care about you that much. We're going to sack you on December the 7th. December the 7th rings a bell for some reason. So over Christmas and New Year, I said to Joe, look, this is the nudge we needed. I'm just going to go full belt into this. I don't know what I'm going to do. We've got income coming in, but all of a sudden I was losing another 130, 140 grand a year of income from Woodside. Now, I documented all of my HMO success and investments and everything that I was doing in various Facebook groups and pages. And when I walked out of the Woodside office and said, I've just quit my job because I've replaced my income, my phone started to ring. People started to ask me, can you help me do this? Can you help me find a property? Can you help me with this property that's been vacant for this long? Can you help me convert this property? Can you help me buy a property? That's when I became a buyer's agent and I started going out there and I started buying property for our clients. And when we bought them, we convert them to HMOs, we put furniture packs in them, we pass them on to our property management business. Fast forward to 2023, we won the award for excellence. Well, we won the award for innovation at the REWA Award for Excellence. We've actually run that in 2023, 2024, and we've just been nominated for it again. And the awards are in November, there's something, can't remember the exact date. So we're going for the triple X, we're going for the triple, the treble. Hopefully we get it. In 2022, that's when I partnered with Troy, my business partner and very good friend. Since then, things have just snowballed big time. And I remember saying to my wife, there's a lot going on. We had something like 3 or 4 subdivisions running at once. We had 5 or 6 houses under construction. We had a few renovations on the go. There was, we probably had about 30, 40. No, we had a lot more than that. We had about 150 to 200 people, tenants that we were managing. And I said to my wife, it's getting to the point where we need some help. We're spinning all these plates and I need some help. And Troy was helping us with a few things here, there and everywhere. So I reached out to him and said, look, how do you feel about partnering up? I don't know what it's going to look like. And he agreed after we went out for dinner with the girls. He said, if my wife gets on with your wife, then we're in business. And I thought to myself, well, Joe gets on with everybody, so looks like we're in business. And at the end of the night, we shook hands. We all had a great night. And we said, looks like we're on. Now, move forward to now. We've launched the Co-Living Collective. We've worked with close to 300 clients now. We've purchased over $150 million worth of real estate, whether that's land, established properties and stuff like that. We've got 650 rooms in our property management business. We've got about another 300, I want to say close to 400 rooms under construction, which is over $74 million worth of construction. If we put all the NDIS stuff in there as well. So easy. Podcast-wise, I got the HMO Property Show. Obviously, you're listening to this. I also ran another podcast called the Perth Entrepreneurs Podcast, where I interview different entrepreneurs around Perth. That's still available. You can probably search that one if you want to. But the majority of our content comes through the HMO Property Show now. So there you go. There you have it. That's the background. I wanted to give you that background just in case you don't know who we are and what we did and why we did it and how we've ended up in this point. So the Perth market right now. Property sales. This is a good indicator of how buoyant the market is right now. We're tackling between 800 and 900 property transactions per month. It's been like this for a long, long time. And even with all the new properties finishing and getting handed over from the builders, we're still in a massive deficit, right? A balanced market, according to REWA, would be 14,000 properties for sale at any one point. Now, that statistic or that statement from REWA, pardon me, get my words out, that statistic and that statement has been there for probably five years before the population's increased quite a lot. So I put 14 to 16,000 there because I believe that more people have came, more houses have been built, so that metric should move a little bit. So 14 to 16,000, I forgot to update that there. Current supply, it says 4,050, but actually this slide from REWA, I pulled it just before we went live. Currently 4,751 properties listed for sale, made up of 3,000 houses, 1,100 units and 526 blocks of land. That's why there's so much demand. That's why prices cannot come down until supply outstrips demand. There is so much demand out there, and I'm going to shake you through that in a second. But prices cannot come down or will not come down until supply outstrips demand. Why would there? If there's still so much demand out there and not enough properties for people to buy, then people are always going to have FOMO. People are always going to pay more money for things when they can do that, obviously. I'm going to take you through that in a second as well. Properties rented, as you can see here, we're averaging around 600 properties a week that are getting rented out. And properties available for rent, this week we've only got 1,955 properties available for rent. This time last year we had 1,700. 4 weeks ago we had 2,000. So look, it's hovering between the 1,800 and 2,000 properties available for rent. A balanced market, again, REWA used to say it was 8,000 to 9,000 properties. That was before we added a lot more people and a lot more properties. Now I believe a balanced market would be 9,000 to 11,000 due to population increases. So you can see right now there's a massive deficit in the market of stuff that we need, properties. And then just move my head a little bit over there. You can see here from the top of the last boom, 2016, this is when we started our business here, and we were filling properties when this vacancy rate was so high in 3 to 4 weeks. But there was a massive oversupply of properties on the market. So if that's not an indicator of a HMO working in both a down market and an up market, then I don't know what is. As you can see here, ever since COVID, people coming back into the state, the oversupply of properties has been gobbled up, and we've just been ticking along here, under 1% vacancy rate for a long, long time. On average, there's 1,300 property vacancies in Perth. These stats are from UDIA, the Urban Development Institute of Australia. Vacancy rate is 0.7%. They say the median weekly rent for houses in Perth is $789 a week, and a unit is $612 a week. You can see this kind of moon sort of shape here, which indicates when the market was buoyant, it all went down here, and now it's spiking back up because there's an undersupplied properties. Why is this happening? Well, as you can see here, on the left-hand side, overseas net migration was always increasing from 2000 to like 2010. So we've always had, since 2000, we've had a lot more people moving into the country than we should have. COVID kicked in, we shut the doors, we opened the doors, boom, we've just skyrocketed. 520,000 people moving to the country in no time. Western Australia is well ahead of their population forecast. We're supposed to have something like 3.5 million people by 2050, and I think we're at 3 million people now. So I think we're going to be well ahead of schedule, which is a problem, right? But where there's problem, there's opportunity for investors, because this problem is too big for the government to fix. It needs private investment, it needs entrepreneurs, it needs investors like yourselves to bring more product to the market, because I think the last stat I heard is something like the government only owns 7% of the rental market, and the rest of it is property investors that are fixing this problem. And people say we're greedy landlords, blah, blah, blah. We're not greedy, we're just trying to fix the problem. We're trying to set ourselves up for retirement, for risking our own hard-earned money by taking a risk on the property market to provide accommodation for people that we don't really know, putting our hard-earned money into that property, and we deserve to be rewarded for it. Now, here's the thing. The trend is your friend, right? So they say in the trading game. You can see here the Australian population is trending. This is right across the country, not just Perth. But you can see it's forecast to continue increasing as well. So I think we're sitting around 25, 26 million people right now. And then we're probably going to get up to 40 million people by 2050 or 2060. So where are they all going to live? The reason that Western Australia is in so much of a pickle, and these statistics are from the ABS, the Australian Bureau of Statistics. See the blue line here on the last sort of boom that we had last time in Western Australia, the last mining boom. This boom is totally different. It's not driven by mining, it's driven by population growth. The completion started dropping off, and then everyone jumped in the property market and started building new properties. But what started happening is the population change started dropping a year or two before that, and then everybody stopped building because they noticed that the property market, or the population increase, was dropping to the lowest it had been for a long, long time. Then what started happening quietly, everybody was so transfixed on Sydney, Victoria, Queensland, Tasmania, that the population in Perth started to increase slowly. People started coming back. This was off the back of some of the mega projects. So we had Gorgon project, Wheatstone project, the Impex project. There was a lot of work that finished, a lot of work that brought a lot of people to the state, but they only came for the work, and when the work finished, they left. So people started moving back, but the problem is, when the population started going up in 2014, housing completions just dropped off the edge of a cliff. And from 2017, 2018, we had more people moving to the state than we had houses getting built. And this, again, gobbled up the oversupply of property from the market. You can see we had a little spike during the big C, and then poof, we've rocketed back up again to the last point. Since 2018, we haven't been building enough houses to keep up with the population, and that's why we've ended up in the situation that we're in right now. As of 2023, we handed over just over 20,000 properties, yet close to 90,000 people moved to the state. Phenomenal. Phenomenal. Now, building activity, as you can see on this graph here, from around 2020, it was slowing down, and then poof, COVID kicked in, spiked, all the building grants came, everything started getting built again. That brought through new houses completions, which you think should have fixed the problem, right? But it's been nowhere near enough. So we're handing over 3,900, let's call it 4,000 properties per quarter. 4 quarters in a year, 4, 8, 12, 16, that's 16,000 properties. We've just seen there that 90,000 people move to the state. Let's say half of them need housing, that's 45. Let's be even generous and just say 25,000 of them need houses because they come as families. We're still in a massive shortage, right? Still a 10,000 shortage just that year alone, and that shortage compounds. See, there's new houses getting started, but only 3,500 getting started compared to the commencements. Sorry, that's including units. This is houses. Other residential typology commencements is 385, so that's apartments. Now, apartments are a great way to get a lot of buildings or a lot of houses / accommodation / shelter to the market in a short period of time. The problem is not many feasibilities stack up right now in the unit and apartment phase. That's why build to rent is becoming a bit of a buzzword, and that's why a lot of the peak bodies, as I like to call themselves, the UDIA, for instance, the Property Council, they're all out there lobbying and advocating on behalf of developers to bring down and introduce tax incentives for rent to buy for the bigger developers. And until that happens, we are not going to meet the demand. We need more apartments, because on a 1,000 square metre block, let's say a 2,000 square metre block, you can probably get 300 to 400 apartments. We're in South Perth, right around the corner there. Finbar and Hanson Construction have just finished Civic Heart. It's an incredible building. Houses close to 350 or 400 people, or that's units, sorry. So, but all these big projects have finished now. The Grove's just finished, Subiaco 1's just finished, Civic Heart's just finished, and there's not many new projects like it coming out the ground again because feasibilities still don't stack up. So, why don't we just keep building houses? As you can see in this slide here, this again is from the UDIA Urban Development Report, which they've pulled these stats from Landgate. As of March 2024, we can see that a lot of vacant land settlements have now slowed down. This can be a few different things. A, there's not enough land available right now for people to purchase and build on. B, developers cannot develop fast enough. We went to a breakfast the other day with Breakfast News and Nigel Sadley. Nigel owns the biggest private land development company in the country, and he's saying it takes twice as long now for them to develop a block of land because there's not enough labour around. So land settlements could be down because A, it's taken them twice as long now to develop and title land, and C, you'll see pretty soon in the next slide that, or the slide after, that the land, lost my train of thought here. So the land developers taking twice as long. What was the other one? Titles. Oh, yes, and not everybody wants to live on the outskirts, right? All the land that's being developed currently is on the fringes. We need more infill, but a lot of it's just external fringe stuff. So, which is low set single story housing, which is good because that's what's affordable right now, but it's not in the areas necessarily that people want to live. People might be forced to live in them areas too. This could also be because construction prices are too high, nobody wants to pay, and everybody's sitting on the fence going, I'm going to buy one when the prices come back down again. Well, here's the thing. I don't think prices are going to come back down again. I think they'll plateau, and I think this will be the new starting point, and then they'll rise again in inflation with CPI. So, as you can see here, this is population increase in Western Australia. You can see there, in COVID, we had no red, which is net overseas migration, and all of a sudden the borders open, bang. 23,000 people last quarter. 23,000 people last quarter moved to the state of Western Australia. Prior to that, we had about 19,000 people. Prior to that, we had about 25,000 people. Prior to that, we had about 22,000. Prior to that, we had about 27,000. I've actually pulled the stat, and it says, just bear with me because I've got it on a different screen. From March 2022, when the doors opened again, as you can see here, population started to increase. 146,000 people moved to Western Australia. In that time, we've only handed over between 25 and 27,000 houses for people to live in, new build construction for people to live in. That is a staggering statistic alone, right? And you can see why we're in a bit of a housing crisis. Now, a lot of people are being driven by the media and saying, oh, but when all these new houses are getting built, people will move into them. Yes, people will move into them, but the growth of the state is increasing faster than houses are getting handed over. 23,000 people moved in the quarter. and we only had 3,500 houses commence last quarter. Do the math. It is simple, isn't it? And the problem is, right, the state government, the housing targets are 47% of new build properties being infill, which means the government have said, we actually want, of all new build construction, we want 47% of it to be infill. It's currently only 9%. Why? Because feasibilities still are not stacking up for standard residential property developers unless you've been extremely, extremely not efficient, but creative. The HMOs work. HMOs work because the end value of a HMO is higher than a normal house. And it doesn't cost you that much different to build compared to a normal house. So feasibilities are starting to look attractive in the HMO space again. We're starting to pick up duplex and triplex sites again. If anybody's interested in investing in small developments, 12, 18, 24 month long, give me a shout. We're always looking for more and more investors to help us bring more and more housing to the market. 91% of housing being built right now is in the greenfield, outer fringe suburbs. So houses are being built, but they're not in areas that people necessarily want to live in. So if we just recap all of that before we get into the next bit, we had record population growth in 2023. We've still got a lot of people moving to the state in 2024. We've got a massive undersupply of housing as per the stats that are pulled from REWA. We've got land settlements dropping over the last quarter. We don't know why. I'm just assuming that it could be one of a number of things or all of them together. We've got construction prices increasing, which is stopping people from building and stopping developments from stacking up, and feasibilities looking attractive. And we've got forecasted population growth of 660,000 to 740,000 by 2035, which will be 3.5 to 3.7 million people in Western Australia alone, which means we need another 304,000 dwellings by 2035, or 27,636 dwellings per annum. And we handed over 17,000 last year, and we're starting around 3,000 a quarter. Let's say 4. So 4, 8, 12, 16. We're still about 11,000 houses short of what we actually need. This is the perfect storm for a property investor. Why is that? Because supply needs to outstrip demand before prices start to drop. Now, interestingly, right, in Western Australia particularly, right, there's a lot of people still talking about investing in Armadale, Rockingham, Kwinana, Mandurah. If we break the market into 3 segments, we're going to call it the low to mid, the mid, and the mid to high. The low to mid is the area that people can afford right now. The reason that the mid section isn't moving is because a lot of people don't have the serviceability right now to go from a $800,000 loan to a $1.2 or a $1.3 million loan. And the reality is, property prices have moved that much now that even if they want to move house, for that jump in price, they're not going to get much more of a different product to what they already lived in. They're literally just going to get to move house. So if we look at the bottom end of the market, Armadale, Rockingham, Kwinana, Mandurah, it used to be the $300,000 to $500,000 bracket, right? It's where investors tend to invest because that's where the kind of biggest pool of investors are. Why? Because it's affordable. I keep banging my chest about this affordable accommodation, standing on my soapbox and shouting about affordable accommodation. But the reason that these markets have moved so much is because prices have gone up, which has increased rental demand. Rental prices have gone up to the point now where people are paying $650 to $700 a week to live in Rockingham, Armadale, and Mandurah. It just blows my mind. $700 a week. I lived, if I go back before Freddie was born, so he's 2 in December, so 3 years ago, me and Joe lived in a 2-bedroom apartment, sub-penthouse, city and Swan River views. We were paying $750 a week. Now people are paying for that for a 4x2 in Mandurah or Rockingham or Armadale. It just absolutely blows my mind when I look at the market now and see these things, right? But the problem is, because so many investors from over east have jumped into these areas because of the yield that they offer and the larger pool of tenancy that they offer as well, it's moved up so high that it's now pushing up into that mid-tier bracket of your likes of Success, Padbury, Duncraig, Morley, these kind of like white-collar suburbs that, you know, a lot of owner-occupiers live in. And it doesn't make sense for these other suburbs to overtake the suburbs that they're pushing up against now, right? But them suburbs can't move because the owner-occupiers that live there can't service the higher loans. And then when we look at the top end of the market, sort of blue chip, South Perth, Mosman Park, Netherlands, Cottesloe, like that market is steaming ahead. Why? Because a lot of people in that price bracket don't use mortgages. They're all cash. There's a lot of cash floating around in the property market right now. CoreLogic statistics say that only 20 to 22% of the property market is mortgaged. 80% of it is unencumbered. And that's because there's a lot of transactions at this price bracket that are happening right across the country. So the top end of the market's running away. The mid part of the market can't go anywhere because no one can get loan approvals from the banks right now. And this bottom part of the market isn't going to move any further that I can imagine, because then we'd have this real mental sort of market where all these kind of what were undesirable and low socioeconomic sort of suburbs would then pass these better suburbs with more amenity, more transport, better schools, better infrastructure, better location. So I think these suburbs will fizzle out now until this mid-tier can move. But the mid-tier can't move until the interest rates come back down. Now, as you can see on this slide here, this is pulled from the RBA. This purple bracket is their target range of CPI. So they want CPI to be in 2 to 3%. It's currently at 3.8% from a high of something like 8.4, if I'm not mistaken, might be 8.5, but it's come down, halved, right? And it's tracking down towards that target range. The experts are saying next year that we're going to see 3 to 4 rate cuts. And when that rate cut does happen, that middle bracket, which I spoke about, is the bracket that's going to move first and foremost. We have been monitoring the market. Joe and I are looking to build our own house. We've been monitoring the market. We live in Kensington, which is part of South Perth Council. The market, we've been going to home opens. There's 20, 30, 40 people going to home opens at properties that are like $1.5 to $2 million. We went to look at a property in Cornwall the other day. You couldn't get parked on the street. The real estate agent was quivering in the corner of the kitchen because there was so many people trying to ask him questions. He was just getting bombarded. They rang me up 2 days later and said, we've got multiple offers on that property. Are you interested in making an offer? And we said, no, it's not for us. That property sold for just under $2 million. And it took 2 days. So it's the market is going to move. The market is going to move once we drop down into this target range, and the RBA released their statement to say the cash rate has come down. That will instill confidence back into the market. It will change the sentiment of the market, and boom, if you're watching this on YouTube, you will see my ChatGPT generated house, which is taking off like a rocket. The market in Perth will take off again. I believe we've got another 3, 4, 5 years run in this market when prices come back down again. The reality is as well, a lot of other states are in a very similar position to us, but Perth seems to be getting a lot of the migration right now. It seems to be getting a lot of overseas migration, a lot of interstate migration too. So just remember, the state government, their housing targets, they want 47% of new build properties being infill, but we're currently only getting 9%, which means 91% of all housing being built is in the greenfield outer fringe suburbs, where people don't necessarily want to live because there's not much infrastructure, there's not much amenity, and the suburbs just aren't as good, and the schools aren't as good. Now, the other issue that we've got, Australia for years has been building the largest houses in the planet. Bigger than America for a long time, right? Only just kind of, we overtook it again in 2017, 2018. Why do we keep building the biggest houses in the world? I don't know. We're in a housing crisis right now. Why are we building 3, 4 and 5 bedroom houses? Now, I've got no problem if an owner-occupier goes out and builds a 3, 4 or 5 bedroom house, knowing specifically what they want for their family to live in. But why is an investor building a 3, 4 or 5 bedroom house? Granted, apartments don't stack up, but if we're building 3, 4 or 5 bedroom houses, we're adding more fuel to the fire to make it just worse. The property market will get worse if we keep adding the wrong product to the market. The other thing is average household size is shrinking, and the rental market, like 70 to 80% of people that are looking to rent houses are singles or couples. There's still families out there looking for them, but why are we providing family houses for singles or couples in the rental market? People think that if you build a 3 or 4 or 5 bedroom house, it's going to have more resale value. We built some single bedroom houses in the suburb of Palmyra. We showed them to the real estate agent. Again, their perception compared to ours about smaller, smarter living was totally different. They literally laughed me out of his office, said, "You're never going to sell these things, mate." Well, you will, but they'll be worth like $340,000, $350,000. We sold them for $420,000 for the single-story ones, and the double-story ones are sold for $495,000. Single bedroom dwellings in Palmyra. The agent was blown away by how much we actually got for them. More because they're in a family suburb, right? But we know that not everybody needs a family house. So build smaller or build the same size house, but fraction it up into little pieces, rent it out individually rather than just renting a big house out to 2 or 3 people or 1 or 2 people, because they don't need all that space. So on top of household size shrinking, we've got single person households increasing. Something like 26% of all households right across the country right now are single or lone person households. Let's think about that. There's 3 million people living in Perth. Let's say 25% of them people are going to end up in single or lone person households. So 25% of 3 mil would be 25% of a mil would be 250, 500. So 750,000 people potentially need access to 1 bedroom, 2 bedroom apartments, 1 bedroom, 2 bedroom houses, or HMO rooms. Yet we continue to build the same things over and over again, expecting to get a different result. Isn't that the definition of insanity? I believe Einstein brought that one in. And on top of these single person households, we've got social isolation. I always struggle to say this. Social isolation and a loneliness epidemic going on right across the country right now. People are saying they're more isolated than ever. People are saying that they feel lonely, they feel disconnected. They're getting in on a night, they're walking around in these big houses, they're looking in the spare bedrooms and just going, no one's been in that room for months. And we're feeling isolated. So HMOs bring back community, bring back connection. And if you're an investor now, in the next few slides, what I'm going to do is show you how we can take advantage of a huge mismatch in the market and build a multi-million-dollar, multi-generational side hustle. Because you don't need to quit your job and you don't need to go full-time into it like we did. If you like your job, if you like what you do, then you can build a property portfolio, a side hustle, whilst you're still working away. But what you don't want to do, is what I see a lot of people do, is they build a property portfolio that ties them to a job because they need that income to cover the shortfall in the rental income that property creates. So if you've been following us for a while, you've probably seen some of the bedrooms, some of the floor plans that we've done. Kitchen, dining, living area, we always keep them in our HMOs. Bedrooms have got en-suites, kitchenettes in them, kettle, toaster, microwave, fridge, freezer. They've got sliding robe, desk, 2-seater table and chairs, sofa and TV. So they've essentially got a micro apartment. $375 to $425 a week. This property itself would cost you around $1.2 million, $1.3 million, and would generate between $117,000 and $132,000 of annual income every single year at full capacity. Now, well, don't worry, I'm going to take you through all the skeptics out there. I'm going to take you through some of the numbers in more detail. Even though I've been chatting for 43 minutes here, this could go on for another 15-20 minutes, guys, so strap yourself in because I'm going to get into the figures, the nuts and the bolts, and exactly how this works. This is a single story one. You've seen them all before. Again, kitchen, dining, living area. If you're going to go out and do this, guys, please keep the living areas. Do not do what they do over east and just take them living areas out and focus on the rest of the house. Make it look like a house, make it feel like a house, but make the bedrooms feel like little micro apartments. And again, double story, seen very similar to the other one. Now, people always ask me, who lives in these houses? Now, I did a podcast on the HMO Property Show, episode 61, about the rental affordability snapshot by Anglicare Australia. And the rental affordability snapshot was where they took a snapshot of the market of Australia, the rental market of Australia. And they wanted to see on that night that they took that snapshot, how many properties were affordable for a cohort of workers that they classed as the essential workers. And the essential workers are aged care workers, cleaners, dispatchers, postal workers, social and community workers, ambulance offers, construction workers, firefighters, meat packers, retail workers, childcare workers, delivery drivers, freight drivers, nurses, school teachers. Now, if you did invest in this 3x2 or 4x2 model, I'm pretty sure some of them people or some of them occupations would be the perfect tenant for you. They're going to wake up in the morning, they're going to have their shower, they're going to have their breakfast, they're going to go to work all day, they're going to come back. Sometimes they're going to pick food up on the way back to the house, or they're going to get an Uber Eats delivered while they're in the shower. They might watch telly for an hour or two and then they're back in bed. Good, hard-working Australians that just need affordable accommodation. But on the night that they took the snapshot across Australia, in Western Australia, there were only 6 properties that were affordable to this cohort of workers, which was 0.2% of the listings. These people deserve and need affordable accommodation that's clean, safe, secure, so that they can go to work and be their best versions of themselves to provide the essential work to this country that we need, that we take advantage of on a daily basis. Why do they rent these properties? 3 reasons that I always talk about: affordability, convenience, and community. You can rent one of these rooms in a HMO for a third to half of what it would cost you to rent a full house and pay the bills in that same suburb. It's affordable. That's the thing on everybody's lips. Affordability. Everybody wants to save money so that they can go traveling, they can invest, or they can just live a life. They don't want to be pouring half of their wages on housing and accommodation. Convenience. We put these in places that people want to live, where there's work, where there's demand, where their families live. We know now, after housing well over 1,500 people, why these people want to live in these houses. The data that we've collected since we started investing in this style of housing, it's in 2014, is phenomenal. And it builds community. So if we go back to the social isolation, which I always struggle to say, social isolation, and loneliness epidemic, why do they feel isolated? Because they've got no one around them. A HMO gives these people the opportunity to socialise if they wish to in a common area, or they can go and lock themselves in the bedroom and stay out the way if they need to. Giving people options: affordability, convenience, and community. Now, for the people that are watching this on YouTube, I'm going to show you exactly how a single story 6x6 property can help you build wealth twice as fast as everybody else by investing in a property that yields a 10% yield, is sat at principal and interest, and then you use the additional cash flow to pay down the debt along with the principal component that the bank technically force you to pay. So in year 1, you'd have no income here. You can see we're under construction. It's going to cost you around 26 grand in holding costs to do one of these things. Year 2, we've got our property, our rent coming in, $350 a room on average, 109,200. We've took vacancy out of there. That is 18 days per annum per room, so technically 3 weeks. We've took out property management fees. We've took out, that includes leasing fees as well. So when we're giving you these figures, we've factored in a month of vacancy, 3 weeks of vacancy and a week of leasing fee. So 4 weeks of rental income deducted. Then we've got your holding costs, so your gas, water, electric, internet and cleaners. And then you've got your loan repayments here. This is set at 7% principal and interest. So 64,820 is $51,000 worth of interest and $13,000 worth of principal. It leaves you with $2,600 of cash flow after you pay all of your expenses. Now, the model that we've got in front of us here shows that this $2,000 gets paid off the principal. Interest is calculated daily, so the more money you can put against your loan means the faster you'll pay off the loan. What you can see here, that in year 5, if you started building one of these in 2025, in year 5, which is 2029, if you've got 3% rental increases every year and you've got 7% capital growth every year, then your rent will have gone from 109 to 119,000. Your cash flow will have gone from 2,000 to 12,000, and your property value will have went from 980 to 1.2 million. If we go fast forward to year 10, you're generating $38,000 a year. Your property is worth 1.6 million, and in 17 years, you've paid off all your debt. And when you're debt free, your property is generating $108,000 a year and spitting out $108,000 a year, and it's valued at 2.8 mil. This is if we get 7% capital growth every year. To model, guys, it's not perfect. It's not going to factor in 7% one year, 23 the year after, -1 the year after that. It's just saying a nice smooth line if you get these things. Lots of variables can happen. However, it's shown that if these things do happen, you could get more, you could get higher room rates, you could get more capital growth, you could get less. But if you do get 7% capital growth and 3% room rate increases, 17 years, you're debt free and you're not in a bad position, right? You haven't had to time the market. You haven't had to find the next hotspot. You haven't had to do X, Y, and Z. You've just had to buy and build one house. We can do all that for you as well. And then you can go out there, enjoy the rest of your life while this property takes care of itself and gets you in a position that a lot of people would never get themselves into. Excuse me. Now, for the business owners out there, we created the multi-generational, multi-million-dollar side hustle on autopilot. If you're a business owner, you're earning $350,000 a year in net profit after all expenses, after you pay yourself, then you can potentially put $350,000 every single year for the next 5 years into one HMO. That would mean you'd have 5 HMOs. Pardon me. You'd have 5 HMOs that are all going up in value. They're all getting room rate increases. And in 12 years' time, your gross rental income would be $683,000 a year. After all expenses of all 5 properties, you'd be generating $196,000 per year. Your portfolio will be worth $8.1 million, and your LVR across your portfolio will be 28%. Not too bad, eh? You'd have $5.9 million worth of equity, which isn't too bad. And what we did is we modeled it out across 25 years. And in 25 years, it would take you 25 years technically to pay off the debt on all 5 of them properties. But in 25 years' time, after you pay off the debt, and you've worked your ass off in your own business for a long time, and you've just left the HMO Property Co. living rooms and the co-living collective to manage all of this for you, 25 years, you'll be debt-free. Your property will be generating $597,000, let's call it 600 grand of net cash flow after all expenses. And your property value, or property values of the 5 properties, your property portfolio will be worth close to $20 million. That is how you can build a multi-generational, multi-million-dollar side hustle on autopilot if you're a business owner that generates over $350,000 net profit every year. So there you go. Hope that helped, team. 53 minutes. Hope that helps for the newbies. I hope the little story about how I've ended up in this position helped. For the people that followed us for a long time, thank you for your support. Really appreciate it. If there's anything specific that you want to see on the podcast that you want to hear me talk about, if there's anybody specific that you want to bring on the podcast or you think I should try and get on the podcast, let me know. I'll reach out to them. I'll try and get them on. We've got some really good guests that we're negotiating with at the minute, trying to get them on. If we get them on, it'll be cool. And there you go, guys. I will see you again on the HMO Property Show next time. Remember, every master was once a disaster, and every winner was once a beginner.
Thanks for watching. Make sure you tune in the same time next week so you can stay up to date with all cash flow positive property updates.